everybody, welcome back to FinMeUp. Today we'll be looking at 7 high growth stock picks for 5+ years. So these are high conviction growth stocks for the long term. The past 2 months we've seen a massive pullback in high growth stocks. This was mostly due to inflation fears, interest rate hike fears, and general overvaluations as the market was really hot about 3 months ago. These 7 stocks that we'll be covering today are stocks that show huge potential for the next decade. They could be stocks to buy and hold for the long term, but they have their risks, no doubt about that. So make sure you do your own due diligence, as none of this should be seen as financial advice. We're only covering 7 high growth stock picks that we like. I currently own 6 out of the 7 stock picks, so I am also a bit biased towards this. So we'll cover the first one today, which I don't own, but I love the company and I love what they're doing, and if it dips a bit more, I might buy. And that is Cloudflare. Cloudflare does 3 things, and they do it really well. Firstly, they secure your websites and APIs and internet applications, so a bit of cybersecurity. They protect corporate networks, employees and devices, and they write and deploy code that runs on the network edge. Definitely in an industry that has a lot of potential, and it already has potential, but I mean, it's not going to stop. Third quarter total revenue totaled 172 million, which represents an increase of 51% year over year. Let's see how the Q4 results look. Operating at a gross margin of 78%, which is really high. The fourth quarter guidance shows that the estimate they'll make a total revenue of $184 to $185 million, with a full year guidance of a total revenue of $647 to $48 million. Well, they've got a current valuation of $27 billion. So that is annual revenue times 41. So Cloudflare is expensive, very much so. But will they fall further? I don't know. They might. That's what I'm hoping, so that I can buy at lower levels. I mean, it could fall even another 50%, and it will still not be cheap. I mean, this is a really expensive stock, but it's such a great company. But I'd rather want to buy it at a lower price, but it's definitely one to watch. And for those holding it, my opinion is that it is a bottom drawer stock if you buy it, because in 10 years, it will probably be much bigger than it is today. In September 2020, we issued the first buy stock pick on Cloudflare when it was $37. Today it is $84, and just last year November, it was $217. So our stock pick went from $37 to $217 and fell back $84. So that is still a 127% increase from our first stock pick, but now it corrected more than 60%. And I mean, corrections of 60% plus, that is .com levels, the .com bust we saw. So we like it for the long term. They're operating in a space where there is a huge demand, and that is why there is such a high premium on the share price, probably because a lot of the growth has already been put into the stock. The second one I own, and that is Square or Block. Square had a tough 2 months. The share price fell from $281 to now hovering close to $110. The PE ratio is 116, and that is high. But this is an innovative company. They invest heavily in growth. The past 2 years, they've made very interesting acquisitions, including Afterpay and Tidal. So they've got this massive long-term plan of being all about blockchain and the super app on the Cash app. So there's a lot of interesting things happening. Bitcoin's revenue is a massive part of Cash App's revenue. So buying Square or investing in Square is also a bet on Bitcoin, as they believe strongly in Bitcoin. The safer fintech exposure option is probably PayPal, but Square also shows a lot of potential. There's also SoFi, there's Visa, MasterCard, so there's so many in the space. And you've got DeFi, so there's a lot of things happening in the fintech space. But Square, with the acquisitions they made, with the total product value that they give users of the Cash app, plus the point of sale devices, I like Square at this current level. It has really come down a lot from the highs of $281. The third one is one I recently bought. It is also one we covered on the channel last week. The link is in the description, and that is Coinbase. In short, it gives you a diversified entry point into the crypto space, and currently it is undervalued in our opinion, and you can go check that video out for more information. The next one is C Limited, and these are one of my highest conviction stock picks as well. The share price fell more than 60% as well in the overall market dip, yet nothing in the fundamentals has changed. The only bad news, or bad news that could be seen as bad, is that Tencent cut its stake in C Limited. But long term, that's not a worry for me. There could be many reasons behind that. Maybe it was for C to get new contracts, which it would not have been able to get otherwise. Maybe it was just Tencent looking to get more capital to invest other businesses, because they still have shares in C Limited. But if you look at C Limited's business and diversified business growing with rockets underneath it, so C also gives you a geographic diversification into Southeast Asia. That is what C stands for. It also gives you exposure to gaming, fintech, and e-commerce, which are all industries with a lot of growth potential. The group's revenue is growing more than 100% year on year, every single year. And it will become more challenging over the next few years to keep that pace of growth, but they are delivering and they are executing. All the businesses that they've started, they've executed and grown, and they are still executing. Garena, which is their gaming business, is very, very profitable. And that is how they can actually fund the fintech and e-commerce side of the business. Looking at their guidance, they actually raised guidance. For the second time, they raised guidance after their Q3 revenues. And they expect the full year revenues to increase much more than they anticipated. So C is, it's in great industries. They are executing. The valuation is not too bad. I mean, especially if you look where it was about 3 months ago. So this is also one, for 10-year plus, and it gives you access and diversification to different industries, but also different geographic locations. To the next one, and that is Tesla. So those who've been following Tesla, that has been following FinMeUp since the beginning, will know that we've been very bullish on Tesla since the beginning of 2020. The first time we published a stock pick on Tesla was when it was $86 a share, and then another stock pick and another stock pick and another stock pick, and now it is $846. It was above $1,000. But Tesla is always expensive and it's always overvalued, and everybody always says it is overvalued, and it is. But after every earnings call, analysts upgrade their stock price forecasts. The share price dips and then it goes back up higher than it was, dips again higher than it was. But then after every earnings call, analysts raise their stock prices or their stock forecasts. When Tesla had a valuation of $50 billion, it was also called overvalued. And it was probably overvalued. But 3 years later, where we are now, they are making annual revenues of around $54 billion. The PE ratio is high, yes, but look how fast the PE ratio is decreasing. Short term, sure, it is expensive and it has its risks. They are busy working on so many things at the same time. They've got just scaling their electric vehicles, ramping up the gigafactories for that. They've got the plans of the Cybertruck, now the robot. They've got Tesla Energy, which is Tesla Solar. They've got Tesla Insurance, infotainment. So they've got basically all these various startups that are parallel to each other. But I mean, isn't that what you want in a business? They are innovating and they are executing. If you look at 3 years ago, what they planned, they executed on. Sometimes here and there, they might miss the targets just. But if you look at, for example, the results that they post, they are exceeding analysts' expectations time after time again. And there's a massive demand for Tesla vehicles. They sell every vehicle they make. So with gigafactories ramping up, supply can increase, meaning deliveries can increase, meaning sales will increase, meaning revenues and profits will increase. And long term, you'll have revenues coming in from Tesla vehicle sales, the insurance, the FSD, entertainment, energy, robots, and what more? I mean, don't think for a second they will stop innovating. And in my opinion, it's cheap with a 10-year time horizon. It's not risk-free, definitely not. And like I said, probably short term it is overvalued. But if you believe in Elon Musk and the entire Tesla team, remember, Tesla is hiring some of the smartest people on earth, working on the different aspects and the different businesses inside Tesla. So they've got a lot of moats. And sure, they might lose some, some market share as Volkswagen and all these other companies also scale their production of EVs, but they will still sell most vehicles that they can produce. And then you've got Tesla Energy, they've got the robots, who knows what the possibilities of that robots and the AI will mean, and FSD. So overall, I wouldn't put all my money in Tesla. I actually sold a bit when it was above $1,000. I posted that on my personal Twitter account. But for the long term, I'm in Tesla. I'm definitely not selling any more shares. I'm actually buying a bit more at these levels after the dip, especially after the results. So for quality research on Tesla, follow the following channels, and the link is in the description. Dave Lee on investing, Chicken Genius Singapore, and solving the money problem. Check those 3 channels for more research on Tesla. Then on to the second last one, and that is Palantir. Palantir is another controversial stock. It's an extremely complex business, so we'll just put this into short words. What excites me is the following. First of all, the management. I know Peter Thiel from the book I read that he wrote, and his track record, and even the management overall and the team that they managed to produce, the amount of skill and talented employees they managed to hire. Then also the rate of growth from Palantir. The commercial side of the business is booming. The total addressable market is huge. The competitive advantages that they have is, to be frank, they don't have competitors. It is so big. The team culture of innovation and long-term incentives. They've got skin in the game. The entire team has skin in the game with the stock-based compensation. The bad thing about stock-based compensation is there is dilution, but it also has its advantages for a shareholder, as you know that the entire team is motivated to actually grow the business. And then also the rate of adding new partnerships and the current partnerships where they add so much value time after time again. If we look at the financials, Palantir is by no means cheap on a short-term level, but if you look at a bigger picture, let's say 10 years, it might be cheap. The stock recently fell from the high of $49 to now $12.75 by the time of this recording, with revenues around $1.5 billion for the year of 2021, and the market cap, which is the valuation, is now around $25 billion. So it's not cheap. Palantir aims to become the most important software company in the world, according to their vision. And if they achieve the revenue growth of 35% annually, which could be even more, but let's say 35% annually up until 2025, that would imply a revenue of close to $5 billion in 2025. They can grow revenues even faster than that, in my opinion, especially if we look at the commercial growth rates, which are more than 100% year on year. That is where the real potential and scalability lies. Look at their customers' retention rates, the rate of additional contracts with existing clients, and the rate of new clients. It is looking really, really good, and I'm super excited to see the Q4 earning results and what news came from that and the new partnerships and all of that. Overall, I'm bullish on Palantir for the next decade. I've been buying more at these levels, and if it goes lower, I'll buy even more. I will not try to time the market, but rather just dollar cost average. They have a huge moat and competitive advantage. I'm holding for the next 10 years at least, because who knows what might happen. On to the last one, which is I recently started a small entry into this investment and this company, but I might look to add more as time goes on. This company is Roblox, which is an entry point to the metaverse. 2 things that really excite me about Roblox. First of all is their new and consistent partnership announcements with key individuals, but also companies. Revenues are also growing extremely fast. That is my second thing that I really, really like. So there's huge quarter-over-quarter revenue growth, and year-over-year revenues are growing more than 100%. So the business is booming. They are still unprofitable. They're not making any profit. But for me, that is fine, because they're investing into expansion and growing how big the business could be, and later on they can turn it into a profit. So as a shareholder, this is my personal preference. I know many people like dividends and profitable companies. I don't mind if they are investing heavily into growing the business rather than, becoming profitable as soon as they want to. So in the third quarter, the platform generated $509 million, while bookings were up by 28% to $637 million, and the net loss for the quarter was $74 million. Almost half of the $140 million loss reported in Q2. So, there is improvement. Roblox also saw an uptick in players, where the daily active users hit 47.3 million people, a 31% increase compared to the same period in the previous year. So, they aren't profitable, but they are showing massive revenue growth. They are showing new partnerships almost on a daily basis. Not quite, but almost. And that's what I like to see. I like to see that they're executing and that they're making revenue, growing their revenues, growing their partnerships, and growing the platform offerings. So these are 7 high conviction stocks. Even though I own 6 out of the 7, the only one I don't own is Cloudflare. Let us know in the comments which high growth companies you like for the long term. This was a mouthful. If you found some value from this, please consider liking and subscribing. Share it with your friends. It really goes a long way. We've got the new FinMeUp app coming almost expected around April this year. So stay tuned for that. Join the FinMeUp community in the link of the description, and check some of the links in the description as well. Maybe you find some value there. Hope you have a great day. Let us know which high conviction companies you have, or high growth stock picks, or which of these you own. Let us know. Thanks for watching. Have a great day. Cheers.